All right, good evening. So this video will be on key levels and execution. So on the Telegram group, I gave an assignment. The assignment goes like this: on your higher time frame for Nasdaq or the ES, monthly, weekly, and the daily, which is the higher time frames we're using currently. Using a horizontal line, outline every PDRA you can see and label. Outline every PDRA you can see and label that PDRA. So how do you go about this? So when I say every PDRA you can see, you've studied, I presume you've been studying this, you've been with us from the episode 1 to episode 20. So you are at least familiar with PDRAs and other concepts by ICT, by other ICT's concepts. So in this your journey, there is multiple PDRAs you come across. So those PDRAs is what you're told to outline. So first and foremost, let's start. I'm currently outlining the PDRAs that I can see by myself. So this will be unique to every individual, respective of the asset class you used for this due, or which PDRAs you've been exposed to. So we'll start. So the first PDRA I can see here is this bearish order block. So we'll call this the monthly bearish order block. So right here we have the monthly bearish order block. Yeah. Another PDRA I can see here is this week here, the midpoint of the week, which is an imbalance, which is the consequent encroachment. So I want to label this week, the midpoint of this week. So here you have the monthly, because it's higher than current market price, so it's a premium week. So monthly, that's it. Take this off. You need as clean price action as possible. What else do I see here in this field of this body of price action? I can see this BC here and also this BC. Right, so here call this monthly BCI, and right below it we have the monthly BC low here. So here you have the monthly and also here you have this monthly BCs. And right below it you have the monthly BC low. This is a very boring and tedious task, but it is needed to help your development to understand higher time frame, key levels, key support and resistance level, because the algorithm will key off of this higher time frame key levels to establish order flow, to align itself with order flow. So it uses this higher time frame order flow to align itself. So here this down close candle here is a bullish order block. So I'm interested in the high and the midpoint of it, which is I'm interested in in the highest body and the lowest body and the mid of that other block. So here label is monthly bullish order block, and at the middle of it, this consequent this mean threshold, the middle of other blocks, whether a breaker block, a proportion block, a mitigation block, or an other block, their mean threshold, it is the midpoint of that other block. While the midpoint of imbalances, whether fair value gaps, BCs, CBs, or a week of an imbalance, or a midpoint, or the midpoint of a week, they are all consequent encroachment. So here is the monthly bullish order block CE, which is the consequent encroachment of the monthly bullish order block. So take this off. So this is everything I can identify around this price action. The nearest PDRA is above the current market price and the nearest PDRA is below the current market price. So dropping down to the 1 week, we are currently doing this drill all from scratch again, because I can tell a lot of people did not partake in the assignment, which is okay. But this is actual mentorship. Mentorship is you actually doing the work that is being rendered, that is being delivered to you at that point in time. Because mentorship is you learning from real-time price action. It's not watching old videos. So it is better you participate in drills like this. And if you are watching this video in a future time, you can participate in drills like this on your own time, even after watching videos like this. One of the best things for you to do is to practice these drills on your own, so that this knowledge, this concept, it will be ingrained inside of your subconscious and it will become part of you, and you will own these concepts like it is yours, which is something you want. All right, so on the weekly time frame, what PDRAs we are currently interested in. So we're interested in this. Let's make this green. So for the weekly, we have this weekly bearish order block. So you have this weekly bearish order block. We also have this imbalance here. This is a BC. So we have this BC, this weekly BC here. So we call this the weekly BCI, and below it you have the weekly BC low. All right, so what again? This down close candle, this last down close candle that took out liquidity before price rallied higher, we have this other block here, which is also resting, which also has this imbalance resting here by the other block. So we're interested in the weekly bullish order block here. So we call this the weekly bullish order block, and this imbalance is here. I like these imbalances here. There is multiple imbalances. There is this imbalance, there is this, and also this. So you can either take all of the imbalances and make it one. When you have multiple imbalances like this, you can make them one O imbalance like this. So this is the midpoint of the imbalance, this is the high, and this is the low of that imbalance. So now on the daily time frame, this is what we have here on the daily time frame. So on the daily time frame, you have this imbalance here, this BC. So here, let's make this red. So call this daily BCI, and below it you have the daily BC low. Also, we have these down close candles here, which is a bullish order block, which became a mitigation block here. But this is you doing this drill more focused on the left hand side of the marketplace, because it is what you price will refer back to when printing at the right hand side of the market. So here you have this bullish order block, this daily bullish order block. One thing, there's a tool I use in my arsenal, which is word discrepancies. So this discrepancies, it helps me align myself and streamline my expectation in price, especially because of this language that we use here. Because for example, when you hear a bullish order block, the first thing that comes to your mind is buy, is to click buy, a buy position, a buy order. And that is not what the narrative is. That might not necessarily be what the narrative is trying to play at that point in time. So a bullish order block can be a target. Does that make sense? And it can also be a point of entry. So you take those PDRAs irrespective of their names, and you look at them as storylines, as plots in a story, as chapters in a book. Each of those chapters helps to make clearer the previous chapter. Does that make sense? All right, so let's continue. So on the daily, we have this order block here, this last down close candle here, which price reaches back down here. So here is the bullish order block. So why are we doing this drill? What is the importance of these drills? So as I stated earlier, the algorithm uses higher time frame PDRAs to align itself with institutional order flow. The institutional order flow in the higher time frame, on the higher time frames, are more respected. They are key levels of support and resistance. Not support and resistance in the traditional sense that like this is a straight line and you do not want it to be breached. This algorithm does not operate in that sense of perfection. For example, if you see this price action, let's hide all of this real quick. So if you look at this price action here, all of this down, this candle here and this candle here, it will be seen as a clean support level, and they will be expecting this support to turn into resistance. So they will place their sell orders at the low of this candle. They will place like a horizontal line here, and when price trades up here on this Wednesday's candle, they place their entry position and their stops above this high or just shy above it. That is so because the algorithm knows this. It knows people are looking for perfection in price and in their lives. So it use this liquidity of this early short. The people that are looking for this to act as a support, broken, turn resistance, it uses them as liquidity, and the Thursday candle rallied higher to neutralize this position and then drop lower. So that is it. We are not looking at support and resistance in the traditional sense. We are using these higher time frame key levels, these higher time frame PDRAs, to align ourselves with the institutional order flow of the lower time frame to get a better trade management and execution. So let's go right straight into it. So on the 15-minute time frame, so from the Monday's trading here, Monday's trading, you had price dug down to this daily bullish order block here. So here you have this daily bullish order block, and price dug down to it and then rallied higher. Now, because the indices market has been dropping, has been extremely bearish, most times you get a retracement in price action, a short-term retracement, or a form of retracement, because the market cannot just be going one-sided. It can't be just delivering sell side. That won't make this an efficient market. It will offer both sell side delivery and also buy side delivery to make the market an efficient market. So hence, when we had all of this drop here for last week's trading, the market came down to a key support level, which is this daily bullish order block. So price dropped down to the daily bullish order block, and as you can see, the wicks are not closing below this key level here when price made this first low here. I would want you to correspond this price action with the S&P, with the ES, which is the US 500, the CDF for the US 5 for the S&P. This US 100 is the CDF for the Nasdaq. When price trades down to a key level, doing a key window, doing a time that we are interested in operating, doing a Q zone. This is why the Q zone is important, because this is when institutional traders, this is when actual professional traders operate in the marketplace. So you want to come when there is injection of liquidity, which occurs mostly within a Q zone. Every PDRA on the lower time frame that is formed in line with your draw on liquidity, say this new week opening gap here, this gap here is your short-term draw on liquidity, because price has been dropping lower and you need price to go to this high, these highs, and also this year as your final target. Say this is your draw on liquidity. This is all hindsight. You are looking for key levels below market prices to act as support, to act as a form of support to take price higher. And when price goes down to these key levels, it leaves a PDRA, it leaves a reference point at or around these key levels. This PDRAs that forms around these key levels, they are of high probability entries for execution or for targeting purposes. This down close candle here that forms at this daily bullish order block resting here, which is this red horizontal line, when price dropped lower here, we note this as a bullish order block. And when price then rallied higher here, doing this up close candle here, you are looking to buy when price comes into this order block, when price drops lower into this down close candle, because this was the last time smart money traders was participating in this market. So you'd want to enter from the order block, and your stop loss at the low of the order block, which is making this key level as a support level, as a key support level. So you want to see this support level hold. And where do you expect to take your position off? At also key levels, at key levels above the market price, above the current market price. So you can offload something at this key level, which is this monthly bullish order block consequent encroachment. This is why we're doing all of those drills from the beginning of these videos, because it gives us when you make your key levels on the higher time frame, there is almost little to no need to do bunch of markups on the lower time frame, especially if you are experienced. But if you are new and just starting out, like less than 6 months in this industry or less than a year at least, you should still be marking up your chart to get this is what I'm talking about, to get the clear understanding of price action. So here you have this bullish order block. This is the order block I'm currently referencing. This is the other block I'm talking about. So when price trades down inside of it, you are not expecting this swing low to be violated because it has backings, it has support sponsorship from a higher time frame key level. So higher time frame key levels provide sponsorships, provide backings to the lower time frame PDRAs. It makes the lower time frame PDRAs be of higher probability. As always, everything we do here in this channel, we always need to have our jaw on liquidity first. So your jaw on liquidity must be established first before you go into the chart looking for entry techniques. So when your jaw on liquidity has been established already, then there's a clear goal in mind. You already have a clear goal in mind you're trying to hit. So, and when that goal is met, you stop and do nothing. You take your profit off, or if you are tape reading, you note it down, you screenshot what you've observed, and you close the chart. This is something that is valuable for new traders. If you're just starting, you want to be content with enough, because greed is like a spirit. It's basically a spirit that when it consumes you, you do not know it is there until it has finished its damage. So for you to subdue this spirit, for you to subdue this greed, you want to be content with enough. You want to have a rigid set of rules for scaling something off, for how you engage in price. Maybe you go for a walk after your take profit has been hit or your stop loss has been hit, or when your tape reading session is over and you screenshot your chart, you take a walk, you leave the chart, you turn off your laptop or your computer, because when you've done something that goes as planned earlier, you might now have this feeling of you being untouchable, that you can participate in all little market fluctuation, and that is wrong. That is an invitation for disaster. So you should align your goals to meet your current financial goals. In this, using this as an example, you should align your goals, your current goals, to meet your financial goal. For example, your financial goal can be you just making what you currently make in your job. Say you have a job, or your current monthly expenses. So that can be your financial goal. So if your current expenses is $300 in a month and you have to make $300 a month, you do that math and you make about, and you do $75 in a week. You make $75 in a week. $75 in a week in this market is easy to do. Use one contract. If you're trading the mini S&P, one contract, getting just two handles is $100. Two handle move is $100. So you can easily scalp out a two handle move from the market. I'm not advising you or encouraging you to stick to taking just two handles from the market, but you get the point. The point is you having a goal in mind, a goal to reach. Because if you have a goal, you have something tangible to look forward to. You have something that you've already visualized in your mind's eye, that this is your target. So when you have a target and a clear line of focus, it keeps you disciplined and focused, because your goals has been laid out clear and has been laid out loud and clear. So we'll only do a few examples of this. Another assignment is for you to go into your chart with this higher time frame key levels marked out, and then you drop down to your 15-minute time frame or your 5-minute time frame, and then you backtest all of this and see how price does act around these key levels, how it uses it for execution to align itself with other flow, because the higher time frames are dominant. These lower time frames, these 15 minutes, 5 minutes, every lower time frame as opposed to your higher time frame of that your current chart, they are those lower time frames are subordinate to what the higher time frames are doing. So hence, when you have a higher time frame key level sponsorship backing your narrative, backing your execution and your bias in price, it gives you a more streamlined and a more precise entry point. Here, when price created this higher, price then rallied higher and dug inside of this key level, which is this daily BC low. So when price does this here, we dropped lower. This last up close candle here, this last up close candle here is a order block. So you're expecting when price comes to this up close candle, you're expecting price to not stay long in this up close candle here. So you're expecting this up close candle now to resist price because it already has an higher time frame. It already have a higher time frame sponsorship backing the direction of your drawn liquidity, which is this lows here, this liquidity void, and this lows here. So when you have price action like this, you are looking for key levels above a market place to act as a resistance, resisting price from going higher. When you're bearish, you're looking for key levels above current market price, looking at those key levels to resist price from going higher and dropping lower. And when it does drop lower, those key levels below those market price, price will trade through those key levels. Those key levels will not act as support. They will break down and price can then retrace higher for those key levels to be acted upon as a support and resistance idea. But this is all contextually. So for now, just focus on when you're bearish, those key levels should be acting as a resistance level. So if you sell from this, you place a limit order from this bearish order block, your stop loss should be above this high here, which is in line with this key level, because you are not expecting this key level to be violated, hence trading off of this down close candle here. Same thing with this is a different day, and as you can see, as we stated earlier, this idea of key levels acting as support and resistance levels, this is not in a traditional sense of how support and resistance is being explained or is being understood by the general public. This is that key level acting as a support level, preventing price from going higher when you're expecting lower prices. So you don't want to see those key levels. You want to see price acting around those key levels when you are, for this case, bearish. You're expecting price to come below this swing low here, which is this sell side liquidity. You have sell side liquidity resting here, and because you are selling from a higher time frame key level, you are expecting price to trade to a higher time frame key level below the current market price. So price moves from higher time frame key levels, from levels to levels. And one more thing, if price is at a monthly PDRA, a monthly key level PDRA, you want to write this in your journal if you're not journaling, by the way. So if price is at a higher time frame, for example, for a monthly key level, where it goes next to, it's a weekly key level. If it's at a weekly key level, where it goes next, it's a daily key level, like that. So if the range price is likely to trade towards to is from, for example, this is a clearer way to understand it. So if price is moving from a monthly key level, it goes to a weekly key level to offload those initial position. And if it's moving from a weekly key level, you have to backtest this to understand what I'm talking about. If it's going from a weekly key level, it goes to a daily key level to offload that price action. You can scale this as much as you like. If it's moving from a daily key level, it's going to offload at a 4-hour key level. Does that make sense? So when price has made this rally higher here, and this weekly BC is now a resistance level, is now a resistance key level, you do not expect price to trade above the swing high, which resides around that key level. So for this case, for example, you're trading off of this fair value gap on this lower time frame. You're using the lower time frames to streamline your entries for trade management and stop placement. So, and you'd want to offload at a swing low, targeting a subordinate higher time frame key level. So this is why you want to leave these key levels on your chart. So that's it for this video. I hope you got something from this video, and goodbye and good luck.